Hi there. In this video, Patrick Quayle and myself discuss forbearance, how COVID-19 has led to forbearance, how the media portrays forbearance. In fact, it portrays it as payment forgiveness, and in fact, this is not exactly true. It's a form of payment postponement. So we speak about what it is, the problems that are caused by it, the pitfalls to watch, and hopefully you'll learn a little something from it, particularly if you're somebody that has taken advantage of the forbearance that's been offered by lenders. I hope you enjoy the video. Thank you.
Okay, we're back live here. The Wicked Awesome Report, broadcasting at 10 a.m. or a little bit after 10 a.m., depending on the technical difficulties, which we had a few this morning. All the Facebook updates aren't quite working all that well with Zoom anymore. But we're finally live here. Patrick Quayle from Hancock Mortgage, your friend in the mortgage business, here with my co-host at the Wicked Awesome Report, Declan O'Toole from Select Real Estate. Good morning, Declan.
Morning, Patrick. How are you? Other than the technical glitches, how's everything going?
Yeah, other than just finding the right button to push here, I think we finally got it sorted out. So other than that, things are well. Topic for today is forbearance fallout, is what I'm calling it. We've had some really difficult times with people being unemployed and underemployed as a result of the pandemic. There have been some financial initiatives put into place to try and help with some of the housing payments for these people. And it's sort of a double-edged sword. It's helped, but in some circumstances it may actually hurt longer term. And we're going to chat about that a little bit today. Really, it's all around the topic of mortgage forbearance.
Yeah, I think probably something we're going to go back. We did speak about it. You gave some guidance on what people should and shouldn't do at the start of this. So this is, I feel like, there's almost a wrap up on the other side of this.
Yep.
Have taken it, or what that can mean and what to watch for. And I suppose a good way to start here, Patrick, would be to outline what forbearance is. The question I would have is, is it loan forgiveness? How does it impact your loan if you take it?
Sure. So, unfortunately, the mass media has put out information which isn't always necessarily down to the, nth degree accurate. Okay. So the way a lot of media outlets had portrayed it is forbearance is mortgage payment forgiveness. You can just not make your payment for several months. Well, that's not exactly true. Nobody is going to let you off the hook and say, all right, here's 3 months off, 6 months off from making mortgage payments, and you never have to make those payments. They're just forgiven. That's not the case. So really what forbearance is, it's not forgiveness of payment, it's postponement of payment. So what they're saying is you don't have to make the payment right now or next month or for the next 3 months or 6 months, or whatever that timeline is. So you don't have to make it right now, you'll make it later. And sort of when and how you make it later, a couple of different variations to that, which again aren't necessarily the ideal solution for everybody. So the big key here is, and I've even talked to some consumers who are in a forbearance program and didn't really realize what the long-term implications were. So it's not mortgage forgiveness. You still have to make the payment, you just don't have to make it right now. So it's a postponement.
Quick one, it seems like it was very easy to get forbearance.
Oh, incredibly easy. So if we look back to the Great Recession, so whatever, 10, 12 years ago, there were some similar programs in place. However, there were some financial means tests involved. So basically, you had to prove to the mortgage servicer, hey, I've lost my job, I've had a reduction in income, I can't afford to make my payment. You basically had to prove that you had a financial hardship in order to be given that relief on mortgage payments, a temporary relief. Well, under the current program, with the CARES Act, so legislation that was put in place, passed by the House and the Senate, that uh, anybody, anyone who asks for forbearance can be given that forbearance without any financial means test. So basically, all you had to do is raise your hand and say, hey, yes, I'd like forbearance. And the loan servicer was required to give it to you without verifying you've had any disruption in income, without verifying any sort of financial hardship. So you basically just ask for it and you got it.
I actually saw it where one of the major banks. I have funds with them. I logged onto my account to click on a button and we get your forbearance. It was almost like it was doing proactively.
Well, exactly. So just because of the sweeping legislation that was put out there, these loan servicers wanted to comply with what the legislation dictated that they do. However, I think they went a little bit too far with it. So one example, I did have a client who contacted me after seeing some of our previous posts, warning about the dangers of forbearance. So he had logged on to his account online, and like all loan servicers, there was a big button there that says find out more about forbearance. He clicked on that just to get more information. He wanted to figure out what it was, and after he clicked on it, a couple of seconds later, another window popped up. Congratulations, you've been approved for forbearance. I was like, whoa, no, wait a minute here. I didn't want to apply for it. I just wanted to know what it was. So it seems like with most of these loan servicers, if you even mention the word forbearance, you're automatically put into that program. Which again, yes, it's trying to help people that have financial difficulty, but sort of sweeping across the board, putting everybody into that program, not necessarily the best thing for everybody involved. And while the CARES Act certainly was put in place and has helped a number of people, I think without that financial means test in place, a lot of people got forbearance that just frankly didn't need it, that didn't need to get it. And unfortunately, now some of those people are facing some of those consequences.
So Patrick, just to get back to that, so here I am. I get off of forbearance. Great, don't need to maintain my mortgage for 3 months, 6 months, whatever. You just mentioned consequences. What are the possible? So it's obviously you need to discuss with people. What are the possible consequences of taking forbearance? You don't want to go over something we've talked about before, but it could be important.
Yeah. So and because the CARES Act was something new, so, this sweeping legislation that came into place, sort of the rules were being written on the fly. Okay, nobody really knew how it was going to play out and what those postponed payments were really going to look like at the end of the day. So those postponed payments, again, it's not forgiveness. You're skipping payments that need to be made eventually. So let's define what eventually means. So it basically falls into, I guess, 3 different categories. So let's say, Declan, you had been approved for a 6-month mortgage forbearance program. So at the end of that 6 months, so in month 7, you get a bill, and it's the regular monthly payment that would normally be due in month 7, plus a requirement for a lump sum payment of those 6 months worth of payments you've skipped. Okay, so let's just be honest here. Whether you've had a financial hardship and lost your job or not, for whatever reason, if you haven't made or weren't able to make 6 months worth of payments, how the hell are you going to pay 6 payments all at once? It doesn't make sense. So that was really option 1. And as the sort of first round of forbearance clients, took advantage of that, that was pretty much the default way to deal with those skip payments. Okay, you got a lump sum that is due at the end of the forbearance. Now, like I said, most people just don't have the financial capacity to be able to do that. So now we go on to sort of the next stage. Okay, well, if you can't pay that lump sum, what happens? A couple of different options. the loan servicer typically will tell you, okay, so if you've got 6 months worth of payments that haven't been made, you can make up those 6 payments over time. So start making your regular payment plus an additional amount every month until you're caught up on those 6 months worth of payments that were skipped. Okay, so your payment is higher by $500, $1,000, $2,000 a month until that 6 months worth of payments skipped have been paid back. All right, still not, an ideal situation, but it's better than one lump sum payment. Okay, now some people.
You're still for finish. If you really need it the first place, that's not ideal.
Exactly.
Again,
exactly. So again, there were some people that even that increased payment to pay it back over time would be a financial hardship. So the next stage beyond that was, okay, well, loan servicer can take that, again, 6 months as the example, 6 months worth of payments that weren't made, and tack it on to the end of the loan. So in other words, you took out a 30-year note originally. They're modifying that agreement. So it is a loan modification. They're modifying the agreement and taking those 6 months worth of payments and tacking it on to the end of the note. So really, you're taking a 30-year loan, and overall it becomes 30 years and 6 months. So that, for a consumer, that's typically the most financially viable way to resolve the forbearance, those postponed payments, tacking it onto the end.
How does that affect your credit?
Well, not exactly. So the good news for the consumer is, as part of the CARES Act, it is mandated that those loan servicers do not mark the consumer as having been late. So if you took advantage of the forbearance program, you don't have a 30-day or 60-day late payment on your mortgage, okay? But the credit report shows that no payment was made. Now, that's going to be a very important nuance when we get into sort of what the next step and people looking for financing post forbearance. So again, the CARES Act dictated that if you went into a forbearance program, the loan servicer can't mark you as being late. So there's going to be no negative impact to your credit report. Your scores are not going to drop. You're not going to be reported as late. So it's a very sort of specific nuance just around the forbearance and the CARES Act. And that's not just for mortgages, that's for auto loans, credit cards, really any financial agreement where you took a forbearance, that loan servicer can't mark you as late. So it's not going to have a negative impact on your credit. Also, specifically with mortgage transactions, if you did take a forbearance, those postponed payments, the loan servicer cannot add any additional interest or late charges or penalties or fees. It's simply just the regular payment that you normally would have made. It just gets postponed to a later date. And like we said, either a lump sum payment or spread out over time or tacked on to the end of the mortgage. No additional charges. So if anything, with the CARES Act, that's definitely something that's helpful to consumers by taking advantage of a forbearance. At the end of the day, they're not necessarily paying more than they would have otherwise.
So if you look at it, so let's say you take this forbearance, right? You do those for 6 months. Maybe you make those payments and you get a break and it has no effect on your credit.
Yep.
So you're of the entire switch, you're taking that forbearance. You have to, you may need to tack it on to the regular loan.
Yep.
Your credit's not getting impacted. Is that it? It doesn't sound too bad.
No, I mean, in and of itself, if that was the end of the story, that would be great. And for the consumers that did have a financial hardship, they lost their job or reduced hours and just didn't have the income to make that payment. If that was the end of the story, well then great. It's a win for the loan servicers. It's a win for the consumer. But there are some, I guess, unintended consequences that come out as a result of that. And again, sort of the rules being written on the fly. So there's not exactly one set of concrete answers. So the next part of the conversation, I'm going to give you some general information as to how most companies are handling transactions going forward. Okay, so let's say, like you said, Declan, you have a consumer who has taken advantage of the forbearance offering, they, based on their financial situation, they took the third option there and having, that payment tacked on to the end of their transaction. Well, we're in an environment now where we have historically low interest rates. Okay, and let's say that consumer is back to work, their job, their office, their whatever it was they were doing, now back open. They're back working their regular working hours, earning the regular income stream that they had been, and they want to take advantage of the lower interest rates to help improve what those mortgage payments are, just as anybody else would. Makes perfect sense. Well, now there becomes a problem. So while the loan servicer has not marked that consumer as being late, so they don't have late payments, there's not a negative marker on the credit report. On the credit report itself, we can see when a payment was made and how much was made. So if we have a period of 3 months or 6 months where there's a mortgage payment technically that is due, but because of forbearance, they haven't made that payment, again, they're not being marked as late, but we can see in the credit report that no payment was made. Now that becomes a problem, because if you're seeking mortgage financing to either purchase a new home or to refinance your existing home, the most important thing that a lender is going to look at when they're looking at your credit history is, have you paid your mortgage on time? So even though technically you weren't late, we can see a 3-6 month span of time where no payment was made at all. Okay, so again, just generalizing here, because different companies have different takes on what the result is, but generically, the requirement is, if you've taken a mortgage forbearance and now you want to either refinance that mortgage or you're looking to sell that home and purchase a new home, a couple of things have to come into place in order for you to qualify for that new loan, either purchasing the new home or refinancing the existing home. Number one, any skipped payments have to be paid back in full. So if you skipped 3 months or 6 months worth of payments, the credit report shows you weren't marked late, but we can see that those payments were skipped. You have to pay that back. And sort of in this post-forbearance world, even though you're not late, it's sort of viewed as bringing the loan current. You don't have anything extra tacked on. In effect, even though you weren't required to make the payment, you have made the payments.
That essentially makes null and void the idea of paying in the back end. You've got to bring it forward to make those payments.
Exactly. So you have to, all those skip payments, you do have to pay them. And what is another financial barrier is, once you've come out of forbearance, you've got a waiting period in terms of when you're going to be eligible for financing again. So on the short end, that's 3 months. On the long end, it's 12 months. So once you've come out of forbearance, you've got anywhere from 3 to 12 months, and most companies are at 6, sort of right in the middle. So once you've come out of forbearance, you've completed that forbearance plan, you've got 6 months of waiting time before you can close on that new mortgage. Again, whether that's a refinance or a purchase. So you need to pay back the skip payments, and you have to wait on average 6 months before you can close on that new loan. So again, the rules are sort of being written on the fly here. Nobody knew exactly what that new qualifying parameters were going to look like once forbearance had ended. But in a nutshell, that's what it is. You have to pay back the skip payments, and there's also going to be a waiting period.
So if that's the situation, is there anything that anybody can do, or what's being proactive? It sounds like you've already gotten into forbearance.
Yeah, if you're already gone into forbearance to a certain degree, sort of the horse is out of the barn. There's nothing that you can do about it if you've already entered forbearance. I think that if you do have a plan or an idea that you may want to refinance or you may want to purchase a new home, the best advice is just complete that forbearance plan as quickly as possible. Even if the loan servicer has put you in that forbearance plan, you can still make, and the loan servicer will accept that monthly payment. Okay, so you can, I guess, self-select yourself out of that forbearance plan and start making your payments. And again, it's going to be on average a 6-month waiting period from when you come out of forbearance. So if you do think you want to do something, either purchase or refinance, the best advice I can give you is come out of that forbearance plan as soon as possible so you can start that waiting period as soon as possible.
I imagine that most financial institutions will reduce it from forbearance. It's in their best interest anyway to have you pay it sooner rather than later.
Exactly, yeah. So if you want to come out of forbearance, contact your loan servicer, explain that you're, financially back on your feet, and you're capable of making those payments, and you want to continue making your payments on time. So maybe you've only missed 1 or 2 payments as opposed to 3 or 6. So the financial burden becomes a little bit lighter. And again, once you've started making those payments again, the sooner you do that, the sooner you start that waiting period.
We've covered there, Patrick.
Yeah, so the forbearance fallout. So again, in theory, great idea to help consumers that are facing some level of financial difficulty, but some of the unintended consequences that played out turn out not to be all that great for everybody involved. And of course, everybody's situation is going to be a little bit different. So if you are watching this and you have gone into forbearance or you're thinking about doing it and you want to talk about what those consequences are and what the next steps are, by all means, reach out to me, shoot me a direct message here on social media, or give me a call, shoot me an email. All over social media, you can easily find me, and happy to walk you through what the implications for your specific situation might be.
I know, Patrick, obviously you're an expert on not just forbearance, but anything in regards to financing or refinancing a home. So it's definitely worth a phone call.
Yeah, well, that's after this long in the business, I suppose. Yeah, I should consider myself an expert. So thanks for that nomination. Appreciate it, Declan. All right, so let's wrap it up as another edition of the Wicked Awesome Report. I am your host, Patrick Quayle from Hancock Mortgage Partners, your friend in the mortgage business, joined by my friend in the real estate business, Declan O'Toole from Select Real Estate. Thanks everybody for tuning in. Give us a comment, a like, a share. Head over to the Wicked Awesome Report page on Facebook and give us a like there. You'll be notified next time that we do broadcast live. So until the next edition, thanks for joining us, Declan. Hope everybody out there stays well and stays awesome. Take care.